Market volatility and concerns over the European sovereign debt crisis is driving a global slowdown in deal making. Joining us now to talk about the prospects for M&A is Laurence Grafstein, co-head of mergers and acquisitions at Rothschild. He is at our deal desk with Cristina Alesci. Cristina, take it away.
Thank you. Well, thank you so much for coming to Deal Desk today.
It's a pleasure.
Really appreciate it. So, looks like despite the large deals that have been announced, even this week, the M&A market is losing some steam. But I'm curious to get your point of view on, look, you're talking to clients, you know what the pipeline is. What are the percentage of deals that will actually see the light of day that are being negotiated right now?
Yeah. Well, I think, Cristina, even though we have a very difficult market environment even this week, you still see signs that certain pockets of the M&A market are just fine. I do think you have to differentiate between some of the larger capital deals that are lower risk for banks to finance and markets to finance from middle market deals on the one hand, cross-border deals where because of the challenges in the Eurozone, you don't see the same type of volume of cross-border activity even among big companies that you're seeing secularly in North America. But even in a week like this, United Technologies, very robust deal for Goodrich, Silver Lake and others, an equity investment in Alibaba.
Right.
Just a very solid M&A market in certain sectors of it, even though confidence in other parts of the world has diminished a bit. So.
Right. Now, the tax-free or tax-advantage spinoff has been the favored route for many companies. Can you tell us why they're choosing to go down that road instead of just a straight-up sale of these assets? We've seen Tyco and ITT and Kraft and all of these large companies opting for a spin-out. Yeah,
and the McGraw-Hills of the world and even Hewlett-Packard maybe announcing something a while back a bit controversially, but nevertheless, I think there's a focus on trying to optimize portfolios and also enhance shareholder value for a lot of large cap companies. This type of stock market, not all companies have performed well, even leaving aside the recent downward pressures. And so people are looking for ways to enhance returns, and one of the ways of doing that is to tax effectively separate assets so that the constituent pieces might, on the one hand, add up to more than the sum of the parts, and also be better positioned in the medium term to do acquisitions and even divestitures of their own. So you see Kraft is one good example. They work very hard to buy Cadbury. Once they have those assets in-house, they then reconfiguring them in a way that they think will be in the long term better for the shareholders.
But why can't they just sell that to either another strategic? I mean, private equity's got its own problems right now with financing, so maybe they're not as strong a player, and maybe that's what's behind it a little bit. But I'm just wondering why aren't they selling to other strategics? Strategics have cash.
Yeah, well, I think a lot of these companies are older and mature companies, so that tends to mean they have low tax basis in some of their assets. And again, every company is different. But if you think about it, a cash sale, which is taxable, sometimes has a higher burden to meet than a tax-effective separation. And if it's underneath the umbrella for a shareholder effectively indirectly owning a bunch of assets, like Warren Buffett, people own a portfolio of his assets. If you separate them and you incur a tax, sometimes that's maybe not the best way to maximize value. And if you think about it in this environment too, cash is earning relatively low returns. So if people can reconfigure things effectively and get the market to recognize the benefits of independence of certain units, that can sometimes create more of an uplift than just a straight cash sale, because there really is a question about what do you do with the use of proceeds. And a lot of large companies have strengthened their balance sheets the last couple of years because of the fixed income markets have been terrific. They also may not want to have ironically, a huge amount of confidence to hire a lot of people or build new projects. So cash can be a bit of a mixed blessing. So particularly if you're paying tax on it, there's a question as to whether it's in some context the best thing to do. So you see these large companies, the McGraw-Hills, another one in media, that are working to play for longer term value that way.
Okay. Well, thank you so much.